Happy Thursday, everyone, and welcome to Navigating the CARES Act. My name is Sierra Ladroma. I am the project manager for the Iowa Center's Women's Business Center. The Iowa Center's Women's Business Center is funded in parts through a cooperative agreement with the U.S. Small Business Administration. It's incredible to be able to bring inspiring entrepreneurs, workshops, and events to the community. Now, many of you have received a form to complete. Please do so after this event. This information allows us to continue providing free educational programming for small business owners in Iowa. I'll also put that form in the chat option for you to easily get to. Feel free to use the chat option to add questions or comments. We have a knowledge-filled team with us today from the Principal Financial Group. Please join me in virtually welcoming our presenters, Paulina Engel, April Cottle, Advanced Solutions Directors, and Tyler Phelps and Sarah Freiberg, Financial Advisors. We'll kick things off with April.
Thanks, Sierra. It's very nice to be with all of you today. It's great to see so many participants. So I want to talk with you a little bit about the CARES Act. The CARES Act is named after Coronavirus Aid, Relief, and Economic Security. That's what CARES stands for. It's the largest stimulus bill in our nation's history, with $2.2 trillion of funding the first time around, and then kind of a booster shot of another $484 billion. So I'm going to talk to you about the individual provisions, and then Paulina will talk to you. We'll have some in between, and Paulina will cover the business provisions. So naturally, the best known of the individual provisions is the rebate checks. Some of you might have already received rebate checks. These are $1,200 stimulus amounts for individuals, $2,400 for couples, plus $500 for each child under 17. So as of this moment, I guess the way to say it is the check is in the mail, or it might be coming by direct deposit to your account if you're not outside of the phase-out range. So for a couple without children, or for an individual without children, the full phase-out would be completed at $99,000 single, $136,500 for a head of household, and $198,000 married filing jointly. So if you're above those levels, you will not get a stimulus check unless you have children and you're very close to those levels. If you are below $75,000 as a single individual, $112,500 as a head of household, or $150,000 as a married couple, you should be seeing a stimulus check. That is based on your 2019 return if you filed one, or your 2018 return if you haven't. These stimulus amounts are not taxable income. So important thing to know. If you have not filed a return either of those 2 years, either because you weren't required to or because you just didn't do it, there's a website that the IRS has called irs.gov/coronavirus, and then it's /getmypayment with a hyphen in between each word. So the second biggest news for the individual front is the retirement plan provisions. And we have 3 changes to retirement plans just for 2020. The first one is coronavirus-related distributions. And this is an ability to take up to $100,000 out of a qualified plan or an IRA with no 10% penalty. So yes, you have a tax, but no, you don't pay a penalty. And the tax is spread over 3 years. So that's a benefit, because normally you would be taxed all at once in 1 year. If it's paid back within 3 years of the date it was taken, it's treated like a rollover. So basically you're not taxed on it if you can pay the whole thing back. And if you can't pay it back, then you simply pay the tax on it. And like I said, that's spread over 3 years. Now, who qualifies to do this? If you were diagnosed with the virus, if you had a spouse or dependent diagnosed with it, or if you had experienced adverse financial consequences as a result of being quarantined, furloughed, laid off, or having work hours reduced due to the disease, if you meet any of those criteria, then you qualify to take advantage of this distribution. Now, just a caution, if you or someone that you know is considering this and happen to also be unemployed, it's important to know that in some states it might be considered income. It might affect eligibility for unemployment. That's not the same from one state to another. The second retirement provision is plan loans, and this is basically, we have the normal requirements for taking a plan loan, which this would be from, for example, maybe a 401k plan. Normally, we have a limit of $50,000 or 50% of your vested balance as the limit for how much you can borrow from a qualified plan. For this year only, in fact, the loan has to be taken out between March 27th and September 27th of this year. You can borrow up to 100,000, and you can borrow up to 100% of your vested balance. So that gives another avenue for people who have some qualified plan savings to pull money out of that. That would not apply to an IRA. That would only be for a qualified plan that has a loan provision. Again, who qualifies to do this? The same people who qualify to take the money out of their IRA or qualified plan. Any payments that are due from March 27th to the end of this year can be delayed for a year. Normally, you have to pay off a plan loan within 5 years, but you get to basically ignore the first year with this particular provision. So a special thing that is only available for 6 months because of people being affected by the coronavirus. The third major plan provision for qualified plans is the suspension of the required minimum distribution for 2020. So for most qualified plans and all IRAs, you simply ignore 2020. You don't have to take your own required distribution, and if you're a beneficiary of someone else's IRA who passed away, you don't have to take a distribution this year for that either. So if you were working under a 5-year rule, you would just ignore 2020. Now that rule applies to defined contributions plans, which would include 401k plans. It does not apply to defined benefit plans. So if you have a traditional pension, you're probably going to have to get your money anyway, whether you need it or not. There's a couple of charitable provisions I want to turn to now, and those are very minimal, but they're worth noting. One is an above the line deduction. So this is a deduction on the front of your 1040 for up to $300 cash gifts to public charities. And there's also an increase if you've ever tried to deduct a large charitable contribution and it took up too much of your income and you had to carry over some to the next year. For this year only, that deduction limit for cash gifts to public charities is 100% of adjusted gross income. So if you're in the maybe small category of people who can give at a very high level this year, that's an opportunity. Now, there's 3 provisions I'm going to touch on that are basically what I would refer to as financial distress types of provisions. So these are for people who are having various levels of problems already, and they're, the effort is to make these circumstances a little bit easier for them. One is people who are unemployed. There's a new category of unemployment insurance called pandemic unemployment assistance. It's for people who ordinarily would not qualify for unemployment, such as part-time employees and self-employed individuals. It's also available for those who are unable to work or telework because of the crisis. And there's also some enhancements to unemployment that include $600 more per week as a benefit, 13 additional weeks of coverage, and no waiting period. Normally there would be a 1-week waiting period. We don't have that right now. So some significant enhancements to unemployment insurance. For individuals who are in a bankruptcy situation, a Chapter 13 bankruptcy, normally the ability to modify those is very limited, but because of the CARES Act and this emergency, modifications are permitted if there's a financial hardship for the family that's in the bankruptcy situation. That applies regardless of when they filed bankruptcy. And then the third financial distress situation that I wanted to touch on is a moratorium on evictions and foreclosures. So basically this is for people who have federally insured or federally guaranteed mortgages. including those that are backed by Fannie Mae or Freddie Mac. If they are experiencing a financial hardship directly or indirectly caused by the COVID-19 emergency, they can ask for forbearance on their mortgage payments for up to 6 months with no fees, no penalties, and no extra interest. So they're not being forgiven of those payments, but they can at least ask that they not have to make them. And then they would be arranging with their lender afterward to either tack them onto the end of the mortgage or make them up in some other way. So it's limited relief, but it's at least a help for this time period. Also, landlords who have mortgages that are federally backed and have apartments, for example, can apply for that same relief. If they take that relief, though, they have to extend the same kind of favor to their tenants, that they cannot then evict them for non-payment of rent or impose late fees or notice of eviction or anything like that. I'm going to turn for a moment to student loans. For college students who had to withdraw because of the COVID-19 emergency this quarter or this semester, whatever this enrollment period is for them, they are not required to return unused funds for Pell Grants or federal student loan funds. The institution also is not required to return funds. And student debt for this semester or this quarter, whatever their period of time is, will be canceled if they had to withdraw because of the emergency. Now, I know a lot of students in college are continuing to attend on the internet through meetings just like this, and so that probably would not apply to them, but they at least have, if they had to drop out, if they had to withdraw, then they have at least some relief there. For student loans that are already in pay status, so they're in the process of paying them off, payments can be deferred until September 30th of this year with no interest accruing on those. Now, I want to touch on one other form of relief that falls under the earlier legislation called the Families First Coronavirus Response Act. If you remember, or if you heard anyone talk about it or saw some of the news coverage, you know that that act, which was passed just a little before this one, promises sick leave to employees, and it promises family leave to employees who have kids out of school or a family member who is sick from the virus. There were a lot of employers that just abruptly let their employees go when this really started to break out in early March. Before we had the CARES Act, before we had PPP loans, some employers were just panicking and letting people go. And after the CARES Act was passed and we have some of this help that Pauline is going to talk about, they may have hired them back. So my last bit of information for you is that those who were hired back are entitled to the same family leave that they were promised under this previous legislation. And as long as they had worked for at least 30 days, they are entitled to that same type of relief. So a bit of help there for employees who got their job back, but they didn't know whether they would have that leave provided to them. With that, I'm going to turn the call over to Tyler Phelps.
Hi, everybody. I'm Tyler Phelps. Myself and Sarah Freeberg, also on the call, are financial advisors with Principal. And as financial advisors, where our role has primarily been utilized the most during this time frame is to be kind of the go-between between people like April and Paulina, and probably everybody on this call has been absorbing a lot of information. And you see the rules and the data and the provisions that have been passed. And then the next question is, how does that affect me? Or I want to talk to somebody one-on-one to say, here's my personal situation, here are my employees' situation, here's my business's situation. Excuse me. How can I take advantage of some of these provisions, or how do I qualify for certain things? And here's my specific situation. A lot of times we're right now fielding phone calls or emails from plan sponsors that ask, does my retirement plan right now currently have the structure in place to allow my participants or myself to take advantage of some of these, or do I qualify, or do my participants qualify? And it's basically just to have a point person in our role to quarterback this situation for individual people. So you can absorb the information on this call and then say, okay, the next step is to actually implement some of these things. I need to talk to somebody about my own situation. And oftentimes that's where Sarah and I are being utilized quite a bit. I think the other thing to bring up, and April touched on it, is she talked about the required minimum distribution waiver for this year. And that's been a nice message to send to people, because we all know what is the one thing that you don't want to do when the stock market pulls back, when your investments go down a little bit, it's sell at the bottom. Well, the government acknowledged if that required minimum distribution waiver didn't take place, they would be forcing retirees or people who are over the age of 72 to sell at the bottom. So that was a nice benefit that people can receive, and that's been a positive message to share with people, and then talk about how to plan out of that as well. I will turn it over now to Paulina to discuss about the details on the business aspect.
Perfect. Thanks, Tyler, and good afternoon to everybody. We are definitely happy to be here and to be able to share some of this information with you. So in addition to the multiple provisions that were intended to help individuals that April just talked about, the CARES Act is really largely focused on putting money in the hands of business owners. Especially the goal is to put money in the hands of those who are employers for others. So the hope is that increasing cash flow to these businesses is going to somewhat bridge the gap in this tough times that the business is facing. So with that in mind, the Act approaches the goal of increasing the cash flow for business owners in a couple of different ways. First, I'll talk about a number of loan programs. Some of these are new and some of these are just expansions of previously existing programs. Again, making money quickly available to businesses. The second thing we'll talk about is that in addition to some of these loans that do need to be repaid, there are a couple of programs that are grants or forgivenesses of loan such that the money never does have to get paid back. The third thing I'll touch on is the financial stimulus of a couple of new payroll tax relief options. So these are provided to give some payroll credits to businesses who have employees on their payroll. And then finally, we'll just touch on a couple of miscellaneous enhancements that the CARES Act makes, including some changes to the Tax Cuts and Jobs Act of 2017, again, to generate more cash today and help the business get by. So I have a lot of information. My work is cut out for me. And so I'll start by taking a look at the different loan and grant programs that were created or maybe enhanced by the CARES Act. The first one, and I imagine most of you have heard about this already, or maybe you've even taken advantage of this. This is the Paycheck Protection Program, or for those of you intimately familiar with it, the PPP. This is a brand new program. And as I see it, the goal of this program is to keep companies in business and employees receiving a paycheck from the company rather than applying for unemployment. So initially, the Act allocated $349 billion, that's billion dollars, to the Small Business Administration to set up this loan program. I would say the program was either a great success or somewhat of a failure, depending on your perspective. Once it was up and running, it was so hugely oversubscribed that they processed 1.6 million loans. The SBA said it processed 14 years worth of loans in just 14 days. So shockingly, money ran out quickly. So then a second wave of funding was approved. And in this new wave, another $310 billion were allocated to the PPP program. So the program is still up and running. There are still funds in it as we speak today. So these loans are actually administered by banks, credit unions, or other financial institutions that are authorized to issue SBA loans. It's not directly administered by the SBA, but the money is 100% backed by the US government. The requirements for applying for this loan are significantly less than what you normally would have to show to apply for an SBA loan. In fact, the application is just 2 pages. And right on the application, it says that the estimated time to complete both the application and to gather the data is 8 minutes. So maybe you're a lot more organized than I am. I don't think I could make it happen in 8 minutes, but certainly is a very simple application. No fees to the borrower, no collateral, no personal guarantee requirement at all. And then a portion of the loan may be completely forgiven, and we'll talk about that in just a minute. But any amount that is not going to be forgiven, the interest on that amount is going to be 1% for 2 years. And there's even a 6-month grace period before the first payment is even due. So obviously very enticing loans, and it makes sense why people rush to try to apply for those. So what do you need to know about these loans? Without getting into too many specifics, generally these are going to be available to different types of businesses that have under 500 employees. There are some exceptions. If you're some type of a manufacturing company, or maybe a restaurant, hotel, or a franchise of some sort, then the test is going to be 500 employees per location. So that's how some of these larger companies were able to get some PPP funds, even though they have more than 500 employees. It's because they fell into some of these exceptions for the headcount requirement, where it just looks at per location rather than per company. So the amount that can be borrowed is based on your average monthly payroll costs that the business had in either the last 12 months or back in 2019, depending on which numbers they're going to look at. But the maximum that can be borrowed is 2.5 times your average monthly payroll cost, up to a maximum of 10 million. So the nice thing is payroll costs are more than just what we traditionally think of as salary. It also includes any sick leave that you paid, group health benefits that you paid, or insurance premiums that you paid, retirement benefits, and then it also includes any state and local employment taxes. So there are some other minor adjustments, but that's kind of the big picture. You're looking at all those payroll costs. And basically, once you determine what your average monthly payroll cost is, that's what you're going to multiply by the 2.5 to get your amount. There's one caveat. If you have an employee whose annual income is over 100,000, which comes out to $8,333 per month, that 8,000 is the most that you can use for the salary part of the calculation. You can still add back all those other expenses I mentioned, like sick leave paid and those. But for the salary part, the most you're going to get is that $8,333 per month that you can use. And then that's the amount you're going to multiply by 2.5 times. So for instance, if you have a business that has multiple employees and had an average monthly payroll cost of say 100,000, they can borrow up to 250,000 under the PPP program. In addition to that, the amount of the loan can also be increased if the business took out an economic injury disaster loan in 2020. We'll talk about those EIDLs in a minute, but if you took out one of those loans and you want to refinance that loan into the PPP because you like the terms of the PPP better, you can add that amount to the amount that you're going to get from the PPP. There are some restrictions, and these are important, on what the money can be used for once the PPP proceeds are paid out to you. On that 2-page application, you have to certify that you're only going to use the money for a couple of things. Retain and maintain payroll, make mortgage interest payments, so interest, not principal. You're going to pay lease and utility expenses. So the thing to remember is the loan amount is going to be based just on payroll, but the way that the money is going to be used is a little bit more flexible, but not totally at your discretion. So there's some limitations on what you can use the money for. And why is that important? Because part of the benefit to the PPP is there's also a loan forgiveness component to that program. So before we talk about other loan programs under the Act, I'm just going to touch on this loan forgiveness component under the PPP. So in a nutshell, any of the loan amount that the business takes and uses to pay for those things that I mentioned. So payroll costs, lease, mortgage interest, utilities, those allowable expenses. In the first 8 weeks after receiving the money, that entire amount can be completely forgiven. So nothing to pay back at all. So the thing to keep in mind here, without getting too specific into the granular details, but a couple things that the business does have to do in order to get maximum forgiveness. The business has to make sure that their headcount is maintained as compared to the previous headcount that they had. And also, they can't reduce the salary of any one employee by more than 25% when you look at the previous quarter. At least that's the way that the SBA language reads now. We are still waiting with bated breath to see more guidance from the SBA on some of these forgiveness components. So I'm sharing with you what we know to this point. So with the salary of an employee, what we know is that you don't want to reduce anybody's salary by more than 25 because then there's going to be a reduction in how much forgiveness you're going to get. The other rule that was put on top of that forgiveness calculation is that you have to use at least 75% of the money that you got on payroll rather than those other allowable expenses that I mentioned. Because, you know, the title of the program is Paycheck Protection Program. So they want to make sure that the bulk of the money is going to be used to retain and pay employees. So then at the end of that 8-week period, you're going to need to submit documentation showing that you used the money appropriately, you followed all these requirements, and then the loan amount in the amount of those documented expenses is going to be forgiven. Now, again, if you've reduced headcount or you've reduced salaries of employees more than is allowable, then the amount of that forgiveness is going to go down proportionally as well. So that's the highlights of the PPP and the highlights of that loan forgiveness under the PPP. There's more guidance coming, so kind of keep an eye on that, but that's what we know at this point. The other program, and this one is not new, but it has now been expanded to allow sole proprietors, independent contractors, and some other folks to apply for it, is that EIDL, the Economic Injury Disaster Program. So that program has been in existence, but now it's just available to more folks. Unlike that PPP that I mentioned, this loan is administered directly by the SBA, so not the banks. So the application is going to be made directly through the SBA as well. The loan amount is now maxed out at $2 million. The one thing to mention here is this program also quickly ran out of money. New funding was approved for the program. So an additional $60 billion was approved for this EIDL program. However, at this point at least, the application to the EIDL is only allowed for agriculture businesses. So if you're an agriculture business, definitely take a look at the EIDL program. Otherwise, at least at this point, you're not going to be able to apply. But for those folks who are eligible or who maybe did apply, the EIDL funds can be used for payroll and rent, so similar to that PPP program, but also they can be used for repaying other obligations that the business has. So a little bit more flexible in how to use the money. And so for this loan, you have to certify that you actually had some loss of revenue due to COVID-19, and that's why you need the loan. So for this one, there's no personal guarantee for any amount under $200,000. The interest rate on this loan is going to be 3.75 for 30 years, rather than that 1% for 2 years under the PPP. But the kind of cool, shiny, exciting part of the EIDL is once the business owner makes that application, they can ask for an immediate grant to be paid out to them. Originally, when the act was created, that immediate grant was up to $10,000, and you could get it paid out in 3 days. Unfortunately, again, money went quickly, and so they needed to pull back. So now, instead of being able to apply for the full $10,000, the rule is you can get $1,000 per each employee that you have, up to $10,000. So a little bit more stringent. Still limited to the 10,000, but depending on the number of employees, you may not get up to that 10,000. So they're calling this an advance, but really that 10,000 or that that grant that you're getting, you don't ever have to repay it back. Even if you don't actually qualify for the loan, or if you qualify but decide not to take the loan, you get to keep that advance. And it pretty much looks like it's money you never have to pay back. The thing to keep in mind here is, yes, you can apply both for the PPP and the EIDL, but the amount of that grant that you get under the EIDL is going to reduce how much is going to be forgiven under the PPP. So they don't want you double dipping on those provisions. The other thing to keep in mind, if you do have both, you don't want to be using the money for the same expenses. Otherwise, you're not going to get that forgiveness under the PPP. So if you're going to use money for payroll, make sure you're using your PPP funds, for instance, in that 8-week period, and use your EIDL money for other things, or past the 8-week period of payroll. But you just don't want to be using the same, covering the same expenses with the two different programs. So that was the EIDL. Two other real quick comments I wanted to make about some other loan related provisions. One is there's a program called the Express Loan that's previously existed under the SBA. It's now has a higher limit. So it used to be limited to 350,000. Now it's up to $1 million. So maybe something that you might be interested in taking a look at. And then if you already have an SBA loan that you took out not related to COVID-19, maybe some business expansion loan or some other SBA type loan, under the new act, the SBA is required to pay 6 months of principal, interest, and fees for that loan. So if you have something like that, make sure you're checking that out, making sure that if you're eligible for that, that the SBA is doing that for you. So that's the overview of the different loans and grants that were created or maybe expanded by the CARES Act. These are the things that are getting the most attention, but there's a couple of other opportunities that I wanted to mention because they might be valuable to you. The first is a retention credit against payroll taxes. So this is available for businesses that have significantly reduced their operations or had more than 50% reduction in gross revenues over the same quarter last year, specifically because of some type of a governmental restriction on travel or meetings, or just simply an order of shutdown of the business. So to make sure that the company keeps its employees on payroll and off of unemployment, the company can receive a payroll credit of up to 50% of wages that they pay to their employees. The most you can count, though, is 10,000 per person. So that means the credit is really limited to 5,000 per person because it's based on 10,000 wages, and you get 50% of that. And so specifically, any business that has more than 100 employees, the credit is only going to be available for those employees you're paying wages to that are not working. So you furloughed employees, but you're going to continue to pay them. You get 5,000 per head for each of those furloughed employees. For smaller businesses, though, if you have less than 100 employees, you can get this credit for each and every employee that you pay wages to, whether they're working or not. Thing to keep in mind here, though, is if you're going to get a PPP loan, you're not allowed to take this credit. So they're mutually exclusive. You either get this payroll credit or you get the PPP loan. So be cautious about that. Another opportunity for liquidity in the short term is the option to delay paying the employer share of the Social Security tax. So this is talking about that 6.2 FICA tax. The business can completely defer any payment that would be payable in 2020, accumulate that, and then pay the first half of what would be due in 2020. You could pay the first half at the end of 2021 and the second half at the end of 2022. So basically, you're deferring that FICA tax for over a year, maybe over 2 years, to get that deferral. So again, they're trying to get some more money in your pocket in order to allow for more spending. Here, the thing to remember is you can go ahead and take this deferral, up until you apply for loan forgiveness and your loan is forgiven under the PPP. So it's okay to have the deferral. It's okay to have the PPP loan at the same time. Once your PPP loan has been forgiven, then you can no longer defer any future Social Security tax. So keeping that in mind, this is a nice option for businesses as well. Not a lot of money, but at least something. The last credit I'll mention is the credit that the business can take under that Families First Coronavirus Response Act. So April mentioned that Families First Act, that went into effect before this CARES Act that we're talking about today. That Families First Act basically said that the business has to provide emergency paid sick leave and emergency family medical leave for employees that are impacted by COVID-19. It also says, though, that you can get a tax credit for paying those benefits to your employees. So that's under the Families First Act. And previously, that credit wasn't going to be available to you until the end of the year when you actually pay your employment taxes. And so that didn't make a lot of sense. So the CARES Act changed that slightly. And now it allows you to take that credit in the same quarter that you pay your sick pay or your FMLA payment. So again, freeing up a little bit of cash flow for the company. So those are a couple of different tax credits that you might want to be thinking about. Just make sure that by taking one of these, you're not hurting your PPP chances or just maybe messing up your PPP program. So in addition to those, though, there are a couple of miscellaneous provisions that were also included in the Act that might be of help to you. So without going into too much detail, because these aren't really beneficial to each and every person or each and every business, but for those who are who do stand to benefit, it might be worthwhile just mentioning to that. So if a business needs to file bankruptcy, the business can do that easier now than it used to be able to do. So the CARES Act made that a little bit easier. Or if your business has a large charitable contribution that you want to make this year, now you can get a larger deduction than you could in the past. If your business is carrying a significant AMT credit, you can now use that all at once instead of having to spread it out over a number of years like you had to do it in the past. So again, not beneficial to every single business owner, but for those who do qualify, you might want to know that they exist. And then the one change that I'll talk about in just a little bit more detail, this might be valuable to certain businesses. This is a business that had net operating losses either in 2018 or 2019. And back in 2017, the Tax Cuts and Jobs Act basically said that if you have net operating losses in 2018, you cannot carry them back to any previous years at all. The best that you can do is you can carry them forward and offset up to 80% of your future taxable income. So your losses get to offset your future taxable income, but only up to 80%. Now, the CARES Act basically completely suspends that provision of the Tax Cuts and Jobs Act. And it says that any net operating loss from 2018, 2019, or 2020 can be carried back for 5 years. So you're going to offset your past income. And so if you had eligible net operating losses, you can go ahead and amend your tax returns and claim a refund for those previous years. And that refund actually might be worth more to you today because it's going to be based on those previous years' higher tax brackets. So make sure if this is something you think you might be able to use, talk to your tax advisor, talk to your CPA about whether it makes sense for you to amend your tax returns. And even if you prefer to still carry forward rather than carry back those net operating losses, the CARES Act has completely removed that 80% limitation. So now basically you can offset 100% of your future taxable income by your net operating losses that your business has. So again, a refund or this offset could be a very large benefit for those businesses that can use it. So again, we touched on some of the very much highlights of the act. There's a lot of detail. We talked about individual provisions. We talked about some business provisions. The thing that I want to mention again is really almost daily new guidance is coming out. It's intending to clarify in practicality how these different provisions are going to be applied. So we keep a very close watch on these. We update our materials to make sure that you're aware of those changes. So keep checking in with us. And now I'm going to turn it over to Sarah to share some of her experiences with the PPP loan.
Thank you, Paulina. Again, just to reiterate what April, Paulina, Tyler, and I have said, our experiences thus far as advisors have been fielding a lot of questions. Paulina and April have covered a variety of legislation in a great brief 30 minutes. Everything is very fine print and things can impact other items. So we are working with businesses and individuals to make sure that they are aware of all the nuances that are constantly fluidly being rolled out and adjusted as things go on. A couple items that I do want to hit on that has become even more shed light on the importance of, as a small business owner, is having your own personal board of directors. What I mean by that is in 14 days, the first round of funding went from available to it was out. And a lot of times people were still trying to better understand, what should I be applying for? How do I go about applying, understanding the paperwork and that process? And your personal board of directors is your financial advisor as a business owner. It's your CPA, your tax professional, it's your banker, it's your attorney. Having all of those resources in your corner better set you up to take advantage of the ever fluid environment when it comes to the CARES Act. So that is just a word of advice on that front. If you felt that, or if you feel you don't have that team in place, that's something Tyler and I can help you with. We can make connections to local CPAs, we can make connections to local bankers and attorneys to better suit you and have all of those resources in your corner to assist you with that. So again, a lot was covered today. I do want to pause and open it up for Q&A. Any questions regarding the individual provisions, the business provisions, and or how Tyler and I can help as financial advisors at Principal. I do want to reiterate, Paulina and April did a phenomenal job. They are our internal advanced solutions team. So Tyler and I will be fielding any questions offline. And so you'll use us as that channel for any questions and or assistance that you need from us. With that, I believe Sierra is going to open up the chat feature. Please utilize the chat feature to submit questions for us to open it up to the group.
So a question came in that says, what would be your top ideas for helping find cash flow that will help cover those expenses not covered by PPP money, assuming no other funds have been received either?
I am happy to take that, Sarah. I think some of the things to think about is if you're not going to be taking PPP money, if that's not going to be an option, then certainly taking a look at some of those tax credits. I think that's going to be kind of the quickest, easiest, and clearest way to get a little bit more money to you. Also, that deferral of the payroll tax credit or the deferral of the Social Security tax, I think that's another good opportunity for some cash flow. I don't know if there are other SBA programs that are available, so maybe that's something that might be of interest to you as well. So maybe taking a look at that. Different states, different municipalities, different cities have other loans and grants that you might be wanting to take a look at as well. So those are some of the ideas I have. I don't know if anybody else has any other thoughts.
I'll jump in there really quick on offering more insight there from Paulina. There are a variety of different entrepreneurial grants out there for specific towards artists, women-owned entrepreneurs, women businesses. So different kind of sectors also have grants and provisions that they're putting out to try to help their specific sectors in the market as well. I'll jump in and add a question for Paulina and April. A lot of questions that Tyler and I have been fielding is around the forgiveness aspect. I know that we're waiting to get a little bit more direction from the SBA of what necessarily that means or looks like. But that is a big concern for small business owners of, you know, the PPP money has hit their business bank account, they're using the funds and they're concerned, how do they better document? Are there Excel documents or any documentation? So I'll pause there and see if you have any insight on how to set up their case for that forgiveness after this next 8 weeks.
Perfect, Sarah. Thanks. That is a great question. And I think we get that many, many times over is, what am I supposed to be doing now that I have the money in my hand? How do I make sure that I'm using it properly? We've actually created a tracking tool that's available on Principal.com. If you just go in there, it's available to everybody. We've got a lot of this information that I've talked about and shared, but also there's a tracker that helps you document that you're using your expenses properly, and it should make it easier for you when you go back to your bank and say, I'm here and I want to apply for loan forgiveness. Here's what I spent my money on, making sure that 75% of that is properly paid toward payroll expenses, and then the 25% separately. The other thing I want to mention is, I know that there's a lot of conversations around forgiveness, and obviously that's going to be the ideal. You've got the money, you spend the money, and you get it forgiven. That's the best of all worlds. If for some reason a portion of your loan is not going to be forgiven, it's a 1% loan. That's pretty cheap money for you to be able to use for 2 years before it needs to be paid back. So something to think about. You still need to make sure that you're using it properly. That's not me saying go ahead and spend it on whatever you want, because there are restrictions to how you can use that money. But for those companies specifically that, for instance, don't have as many employees on their payroll anymore, they simply had to let folks go and it just doesn't make sense to keep them employed. Using it for some of those other expenses might not be fully forgivable, but at least it gives you some additional money that you can float at 1%.
There are additional questions on here. One is from Talis, and it says, what guidance is there for commercial leases for small businesses that have had no revenue for 2 months?
I guess I'm not, maybe somebody else has a better feel for the question. You've got the PPP, as I mentioned, would be one of the options that would be available. Trying to think, I don't know if anybody else has any other thoughts.
I'll speak to that
Yeah.
also, just maybe a different angle. I'm not sure exactly what the questioner was intending, but I'm thinking about the mortgage forbearance and protection that I went over for federally insured mortgages and multifamily properties. There is no guidance at this point, to my knowledge. I don't think either of us have seen anything protecting tenants from commercial lease evictions or offering protection for being unable to pay their rent. We haven't really seen that. We've seen some efforts here and there in the private sector for people to say, hey, I know you can't pay it, I'm not going to kick you out. But there's nothing formal at the government level except for those federally insured mortgages and multifamily dwelling mortgages.
It looks like there was a question that came through on the Q&A from Linda. It says, can I get a PPP loan even though we had to shut down for a month, which caused us to put everybody on unemployment? They own a semi and mileage pay is not worth going out on the road until it ends. So their business is completely shut down.
I would say they're eligible for a PPP loan because it's going to be based on previous payroll expenses that they had. Whether that PPP loan makes sense is really going to be an individual decision as to whether it makes sense to take on any more debt if you're not going to be bringing employees back anyway, and it doesn't make sense to do that. So I would say that's something that I would suggest talking to your banker about, or your advisor, your legal counsel, just to make sure that you're not taking on more debt than you're going to be able to use and get forgiven. again, I also understand that I think there's going to be more guidance around that forgiveness component, including I've heard talks of maybe expanding that 8-week program. Maybe that's something that's going to happen. We don't know. Talk about some separate help for businesses that had to completely lay people off, specifically like restaurant businesses is the one that I hear over and over again that are shuttered completely. But we just don't have any more guidance than that at this point, unfortunately. And I see a question about whether there are still funds available for distribution under the PPP, and there are. At this point, they're still accepting applications. My understanding is folks who apply with smaller banks are being more successful in the quicker turnaround of getting those loans processed. There were specific funds allocated to those smaller banks, rural banks. So maybe taking a look at if this is something that's still of interest to you, maybe reaching out to some smaller lenders. You may do better with that.
Paulina, it looks like we missed a question about the use of PPP money and 75% of it being used for payroll. And there was a question, can the other 25% be used for cash flow? I thought you might want to touch on that.
Oh, yep, perfect. Thanks, April. I guess the terms of the application are pretty clear. They're, since the guidance, let me back up. Initially, when the act came out, they just said you use it for payroll, mortgage, interest, leases, and utilities, and that's that. Then as soon as guidance came out, they made those additional limitations to that 75% of payroll, and then the additional 25 to be used on those other things. So I guess in my opinion, the guidance is pretty clear that this is what they're looking for right now. Again, maybe at some point they're going to expand that to allow uses other than just those 4 specific things. I've heard talk about that as well, maybe allowing it for straight up cash flow. At this point, that's not what's out there. So my recommendation would be talk to your lender and just see what their thoughts on that would be.
Okay, thank you so much for your time. Have a great day, everyone.
Thanks, everyone.
Thanks, everyone.